Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I'm giving you a weekly housing market update. And strap in because we're going to have some good information for you here, some really detailed stuff that I think will help make sense out of what's going on in the housing market right now. We're seeing a shift as we've been talking about the last couple of weeks, and we're also going to be talking about new listings kind of slowing down on the coming on the market. So. Right now, we have just kind of give you some overall numbers. We have 36 days closed on market. That's the average. 36 closed days on market as far as how long homes, once they're listed, are sitting there. That gives us a 3.73 month supply. That's actually up near the balanced range. Usually your balanced market for us in most cases is going to be about 4 to 6 months here in the Phoenix metropolitan area. Most of the information I'm going to be talking about is going to be what's going on here in the metropolitan area of Phoenix. But we do get into some national stuff too. But our absorption rate right now is down to 26.85%, which I'll get into more in a bit. But that's basically how fast stuff is getting sold. And then our average list price right now is $697,800, and that's definitely down a little bit. That number has been as high up into the sevens and even close to eight, right around eight before. Our average sales price is 544 and some change. That number is down a little bit too. So well, we're going to see right now that our list to sales price ratio, what the home is listed at and what it actually sells for right now is at 97.99%. So across the board, on average, this is just an overall average, okay? List to sales price ratio, people are getting basically just under that 2% mark, 2.1, below what they're listing their home for in percentage. So keep that in mind when you're listing your property. We're seeing a lot of price reductions right now. If a home is priced properly and a home is what people are looking for, what's in trend, it's got, bells and whistles. It's got at least, 3 to 4 bedrooms, and maybe a pool and a little bit bigger than average yard. Those kind of homes, that kind of have the resorts in the backyard and stuff, they may go a little bit quicker than the properties who need work, haven't been cleaned up enough to really get them on the market to really showcase ready and those sorts of things. So when you're listing a property, just keep that in mind. In general, I would say, we're definitely going to be around on average to go under contract. We were as low as 7 days on market. We're going to be, hovering around, over 20 days on market before a home goes under contract on average. So, again, if you're in the, more properly priced, in the reality of the market shift to where we are now, and I'll talk about why we're there here in a minute and a little bit more. But you'll see that your home will go under contract a little bit quicker if it's, kind of got that trend look that people are going for these days. If it's out of date, needs work, has issues, hasn't been cleaned up property for showings and all that kind of thing, it may take a little bit longer to get it sold and all that. So we can, of course, talk to you about strategies on those sorts of things with your particular property and area. Now, that said, active properties right now, we're over 19,000, which makes sense for what we're looking at, which is up about 3.6% active. But we have seen, that's just due to like a lot of properties just sitting. As far as new properties coming on the market, we're under the 2,500 mark. We're at 2,423. So we've kind of seen a little bit of a slowing of, from what we've seen in the past with some of the peak, which I'll get into more here in detail, of new listings coming on the market. It's more of the properties just sitting on the market longer. So pending, we've got minus 3% as far as homes that are actually under contract or in pending status. means under contract. That's 3581, 3,581 under contract. Still with short sales, lender owned REOs, all that, almost minuscule, almost nothing. We've got 22 short sales, 17 lender owned REOs. We do have 7 HUD homes, which out of 19,000, over 19,000, is pretty much nothing. So nothing happening there as far as skies falling with housing crash or anything like that. People are always waiting for in the wings and hoping for so they can get homes at $100,000 again and get the $100,000 McMansion. Keep in mind, the housing crash of 2008 was more, that's what caused the recession to begin with. We had, at that time, like 56,000 active properties or homes on the market. We're nowhere near that kind of a surplus at this point, and the lending practices were totally different. Plus, people did not have the equity that they have today in their homes. So again, just summing that up again one more time for you. Can't say it enough, I guess, because people are just sitting there listening to a lot of crazy talk on a lot of the stations that are usually wrong about these sorts of things. And I want to make sure we clarify kind of the reality of what's going on out there. Just more of a balanced market, kind of a regular deal. We kind of got spoiled the last couple of years. A lot of sellers did anyway. It's more of a balanced market. Buyers getting some deals as far as that 1 to 2% range that we talked about earlier, was the list to sales price ratio, getting some closing costs, helping to buy down the rate. So it's more of a normal rate, or a rate to what we're used to since, let's say around, the last 5, 6, 7 years. So with that said, let's go ahead and take a look here. We've got closed units, 35.3% down. Closed units, that's due to demand, like we talked about, and obviously that's due to inflationary factors along with interest rates, and that puts us at 1,168 units closed this month to date, week over week, and what we're looking at here. So next thing I want to move on to is by defying expectations, from the Wall Street Journal, it says, by defying expectations of an economic slowdown, the report will make it harder for the Federal Reserve to dial back the pace of rate increases at its meeting next month. Now, rates actually slipped just below, on average, this is just using averages, but they slipped below 5% on average. So we'll see what happens there with that, and their meeting next month. Usually when we hit a recession, though, and right now it's kind of hard because they were trying to raise interest rates to battle inflation, which usually historically speaking could last anywhere from a handful of months, maybe 6 months, on up to the housing crash of 2008. We saw where that was more like 18 months of raising rates, and then due to a bad economy, a poor economy, usually rates will go down eventually in a bad economy. So we've had 2 quarters of negative GDP, which means we are in a recession. Anybody who thinks we have zero inflation, just go ahead, buy some eggs and milk and some gas. Right now, on average, the latest numbers I saw, and the reality numbers, from True Economists, would be about 29% on average is what you're paying more for when you go to use your air conditioner, your heater, which you'd be using in the winter, obviously, but your air conditioner, heater, your gas, and your food. Those are the biggies, right? Utilities, gas, and food, right? So, and I also saw a staggering figure of, some with electric cars. This is a matter of congressional record now, where people using their plug-in cars actually showed that they were doubling. It was like basically doubling their electric bills. Now, again, I guess if you have solar, you could offset that a little bit, but solar can also sometimes work against you when you're trying to sell a house, because that has to be figured into the buyer's overall cost for financing into their financing, which I've talked about before. I'm not going to get into the details there, but basically on an HOA or solar, it's about $50 to $60 or so, give or take a little bit, for every 10,000 minus when you have HOA at least $50 or more. Same thing with solar leases and stuff like that. So just some things to always keep in mind. It's not always cut black and white on a lot of these financial issues, but like I said, the rate did dip below 5%, which is great this past week. And I want to jump right into the CMI. So CMI, the Crawford Market Index, where we get a lot of our information from, the Crawford report, basically is an index that puts us at 100 is a balanced market. Anything over 110 is a seller's market, and at 90 or below is a buyer's market on the index points. So the overall index right now is technically a seller's market in the Phoenix metropolitan area. That would put us right now on the overall average at 118.6. Okay, but our demand is at 80.3. So basically, we are 100 would be balanced, right? So we're about 20 points down or 19.7 points down from that. So our demand is low, obviously due to the inflationary factors, the cost of everything costing more. And then, of course, the interest rates being higher than they were. Last year, interest rates were right around 2.8, 2.9% on average. That's a huge difference. For every 1%, it's about 10% more in a mortgage payment. Plus, the price of homes went up overall over the last year. Now, you may be worried about prices coming down. I'm going to talk about that more here in a little bit. But it's always about supply and demand. Now, the supply on the index is at 67.7. 67.7. So again, that's under 33 or 32.3 points under that 100 mark, that we are under supplied, so to speak. Because like I said, even though inventory is basically tripled or a little bit more than triple, because there were some weeks back when the insanity market was happening where we had like 4,000 something inventory, 5,000 maybe. Now, we're over 19,000. But, really in reality, our supply should be, really in a totally balanced level playing field market between 4 and 6% would be a balanced market. So I'm sorry, 4 or 6% month supply, 4 to 6 month supply. And right now we're at 3.73. So that's telling the story there on supply and demand. So it's still technically a seller's market overall, but in the Phoenix area, but every single city is got down arrows when you take them out and look at them individually in the Crawford Market Index. For instance, again, cities that are in a buyer's market would be a total buyer's market on the index. Again, below that 90 range would be Maricopa, then Queen Creek, then Buckeye. Buckeye is the lowest right now on the totem pole at 64 on the CMI, 67 Queen Creek, Maricopa 79. Then if we from there, if we look at what's in a balanced market, that would be Gilbert, Tempe, Surprise, Chandler, Peoria, Glendale, Phoenix, and Mesa. They're all in balanced markets. So what we're been talking about the last couple of weeks is, in the month over month numbers, we were coming down pretty quickly, week over week, month over month. But in the last week, we've been seeing kind of a little bit of a leveling off of the drops. We're down 31% overall, but it's kind of like a slower pace, whereas before we were dropping 34, 35, 36% on this. So now it's kind of a slowing down of this drop. But we've got down arrows all the way back to April 21st as far as the index goes, meaning that all of the cities before that were, above that 110 mark, or well above that 110 mark. I mean, we had cities to the point to where, on the Crawford Market Index, where we were up near, in 475, 480. And then, we've had this big drop, but now we're seeing kind of a slowing to the drop and a leveling. So we'll keep an eye on that, obviously, as we go along. But the new listings that we had, come on the market, have really changed things, along with the interest rates, to really change that supply and demand. Okay. So, the new listings, by month, we had, 10,500 in April. In May, we had 11,000. June, we had 12,000. June was really that kind of that time frame where we had, the really big influx of FOMO buyers, fear of missing out. Like, we better get out. The interest rates are going up, and everybody's putting their home on the market. What's going on? It seems like prices are coming down, but in reality, appraised values haven't really changed. If you look at the actual true appraised values, I think I've gone over this a million times, but I don't think it can be said enough, because it's really hard to understand for people when they're not in this day in, day out, and looking at the back end numbers and running comps, comparable sales in the area all the time, and how the comp ranges work. But basically, up until around March, April, May, we saw where people were taking the comparable sales, and just because of what had been going on over the last year with crazy sales, we saw where people were, usually would take the comparable sales in the area, and then we get the average. So you have a low, an average, and then a high comparable sales range. Typically, you want to kind of be more towards that average to really be good on an appraisal, or to be safe. But what people were doing is, or what's actually the actual appraised value. And again, if you have a pool, if you're on a golf course or on a lake, for Arizona, that means more like a pond, but they call it lakes out here. You know, those sorts of things, you could certainly add more if it's a brand new home, new build, custom home, all those sorts of things. We can, one story versus a 2-story, those sorts of things would obviously come into play, and how we're working with the comps. But all that said, people were taking the high end of the comps, and then from there, they were even, starting there, or taking the high end of the comps, which could be $20,000, $50,000 over what the average is, and still raising that maybe another 20 to 50,000, and then still getting 10, 20, sometimes up to 50 offers, and it going for maybe $50,000 to $100,000 more than what the crazy list price was. I mean, that was really happening, and people were paying cash, and they were not asking for any contingencies or anything, for inspection, appraisal, loan contingencies, nothing. So we're not in that market anymore. We're nowhere near that market anymore, because demand has gone down due to the interest rate hikes, which basically took us, again, 2.8, 2.9% of last year. Now we're hovering around that 5, give or take a little bit, depending on the day and the week. They fluctuate by the hour on interest rates, so, but that's a big difference. Even if you're going from, let's say, 3 to 5%, okay, let's just use round numbers. That's 20% more in a mortgage payment that somebody's going to be paying, plus the price of homes over the last year went up overall. Okay. And what we're seeing is an influx of these listings. And so that kind of slows down the market a little bit, because buyers now have more choices. We have, the fear of missing out sellers. A lot of the sellers are new builds, second homes, investor properties, which I've spoken about before. Right around 50 to 55% of them are. So, those people are also not going out and buying something else, okay, because they're just selling to kind of get out of the market at this point. But remember, in every recession except the one that caused the recession was the housing market recession of 2008. And there was one other one that kind of went down just a hair, a few decades back, but it wasn't anything like the housing crash at all, and it was a pretty quick recovery. But that one was the biggie. But outside of that, home prices still go up. Now in Arizona, it's about right around 4.5–5% is kind of the average, maybe 6% overall. That's why a lot of investors started coming back, out here in the 80s. But overall, we've always kind of been a seller's market. If we're hovering around that 3-month supply mark like we are right now, that's really a brisk market. And it's kind of a good, healthy market overall. So keep in mind that you've got to kind of look at it from a whole approach, not just a what's gone on in the last year or two with all the people moving because of mandates and lockdowns and all the other things that have been going on. Now, some of the things that we haven't really discussed is I want to talk about the pricing a little bit more and what's really happened. This is Arizona Republic. Kind of gets into the Metro Phoenix median home price poised to fall. It was an article that showed it was poised to fall, and it looked like we were basically our median prices have come down. Let's see, to 450 in July. Okay, now we were up to about 475, 480 at the peak. Okay, that's where we were. So keep in mind that's median, that's not averages. And the overall averages have come down because we had, the largest segment of homes that have come on the market are under 500,000. I don't think I mentioned it earlier. Let me see if I've got it up here. Yes. The largest segment is still under 500,000 by just almost 51%. So the other segment would be after that, 500 to up to a million is 38%, and then above a million is 11%. So keep in mind that it's because we've had this flood of lower priced homes come on the market that it brings down the overall averages. Doesn't mean in your neighborhood for your house it doesn't mean your house has gone down $30,000 or because the median price has gone down that much, or it doesn't for the actual true appraised value, not for the crazy inflated market, but what the true appraised average of comps were and what the sale was. Now that said, we can look at what's going on in your particular neighborhood and tell you more, obviously, of what's actually going on in your area. But it's not that everybody's home price for the actual true appraised value has gone down that much. So I hope that helps as far as those averages and medians and what's going on with that and the overall. Now I would say within the next 3 to 5 years, as I mentioned before, Phoenix is still a hot market, and I'm going to talk more about that in just a second. But in the next 2, 3, 5 years max, I would say we're probably going to be at a median price point here in Phoenix by 600,000. And I'll tell you what, we're going to see at some point where our inventory will probably go down once we kind of work through those second home sellers, those investor sellers, the FOMO sellers. Once we see interest rates come down again by next year to the end of next year, once people figure out that even now they can get great interest rates, may sound crazy, but if you're working with a broker, we can help you with that. You can actually get better rates because they shop the best rates for you. And since we're able to get closing costs much easier now, even from builders, okay, and negotiate that in, you're able to get your rate paid down quite a bit. So it actually will make it seem like we're almost working with numbers from last year on interest rates versus where things are in general are on average nationwide. So let's talk before we go crazy here and not think we can afford a home, not think that we can get a good deal and all that. And on the seller side, I would just say, just keep all this in mind. It's not uncommon for a home to be on the market 2, 3, even 4 weeks before we get, get it under contract, just because it's a matter of supply and demand. It's just the way it is. Okay. So I could go on and on with that, but let's look at this. So I'm going to look at the average homes, the average home prices, and this is just kind of some data that Redfin put together, and out of town owners coming into different areas, and the percentage of differences between budgets of migrant and locals versus locals in particular area. The average maximum, because that's what everybody wants to find out when they get their home loan pre-approval, or if they pay in cash, what they have to work with, what their budget is, and the average maximum of locals versus out of towners, and then what the median price is. So this is as of June 2022. This was interesting. For the Phoenix area, I'm not going to go into all the different cities, but obviously for the Phoenix area, we are looking at the average local budget, the average local budget for our area for people migrating here was 12.9% more, 12.9% more than the local. The guy, somebody moving in from out of state had 12.9% more than the local buyer here locally. Okay, for their average maximum budget. All right, average maximum. Keep that in mind. So for the person moving here from out of state, it was 805 and some change. For the people here in the Phoenix area already is 713, taking that 12.9% into consideration. And then the median sales price, again, this was taken from June, was 485. So that was that's obviously a little off from now, because now we're going to be more towards that 450 mark on as far as the median. And I said earlier, our average sales price is 544. Okay, 544. So I hope that helps as far as some of the pricing, some of the competition that we're looking at and all that. But obviously things can fluctuate very quickly. If interest rates come down again and supply gets eaten up eventually there, our demand goes up, we could be at a completely different market overnight. I would say definitely by the time, just because of the way the seasons go, usually the end of the year, we usually get like a little end of the year rush, but right after the holidays, things start cooking up again. Once people get, done with the holidays, people are thinking about tax season, getting some rebates. Think people are thinking about, maybe moving in between the school year, things like that come up. So for our markets and school, lets out in May, typically for most places here in the Phoenix area, our big season is going to be, like our big months are April, May, and June, and then usually July, August. A lot of people are on vacation too. Keep that in mind too, especially a lot of higher up, managers, directors, executives, things like that. A lot of people go on vacation. So, and then we usually can even get a little influx of people moving here, even because of the school year, right around the same time. So now that school's back in session, we'll kind of see how things go, especially by the time we get to the end of August, now that school's back in session, or right after Labor Day is usually a good indicator of where we're kind of heading for the rest of the year. One other thing I wanted to mention, actually two other things real quick. The Empire Group, it's a big company who's going to be building a large rental community in the North Phoenix area up near the I-17 and the 303. That's because it's sited near the Taiwan semiconductor facility, which I've mentioned before in previous video or two. And it's called the Village at Bronco Trail. It'll include 354 single family build to rent, homes. There's a lot of people who are thinking, they'll buy properties to rent out in that area if they've been paying attention to the news and what's going on with this, because there are going to be a lot of people moving here. By 2024, it's supposed to be completely built up. I would say probably 5 to 10 years before they're really kicking butt in that place where we're at a point where you know we don't need the advanced chips from Taiwan anymore. But we'll kind of see how that maybe gets sped up by a few other things going on out there in the news. But just something to think about, that it's going to be definitely a huge and hot area um going on over there because of that. It's projected to open in 2024, the semiconductor, Taiwan Semiconductor Manufacturing Company, or TSMC. um it's a $12 billion plant. But that's going to be super important for our economy here in Phoenix. A lot of people moving here to work there. Those will be great jobs. It'll bring a lot of money into the area. A lot of people are going to need to buy homes, rent homes. They may want to rent first before they buy. Just something to think about if you're thinking about wanting to do any investing. But they're already doing that sort of thing. And obviously, that's going to bring in at least, they're figuring about at least 3,000 jobs. But obviously that goes out into the community. It could create other jobs for other reasons in the economy. And I've got some questions coming in. I was going to do a separate video on it. I'll just mention it real quick right now. uh Open Doors going through their iBuyer company. They'll buy your home. They buy homes a lot of times cash and those sorts of things. And usually with those cash deals, people get into, well, they own by BlackRock and all these different things. uh I'm not going to get into the weeds on that, but the company is going through a lawsuit right now. It's like a $60 million lawsuit or whatever. I forgot to pull it up here before, but I'll just mention it to you now. The lawsuit is actually from stuff that was on their website or stuff that they were telling people back in 2019. And that had to do with basically them trying to tell people that they could sell homes for more than doing it the traditional way. And I can tell you, you're just putting stuff through right now. I mean, they're not offering hardly anything. Sometimes it's a good deal. We've represented people before on the sale side, and even on the buyer side, who have worked with them. And we are happy to do that if it makes it easier for people. But right now they're offering like I $50,000-$100,000 less sometimes what homes are actually worth, even being reasonable on pricing for a home. But the thing they're getting sued on right now has to do with stuff that happened back in 2019 with some, it sounds like some possibly sensational type of thing where they'd be able to buy your home more, sell your home more than you could on a traditional market versus one person coming in to buy your home. And not to say they weren't given some good deals here in the insanity market, not so much anymore. And sometimes it's really convenient for people, but it's always good to always talk to a realtor you trust and kind of get into the weeds on the details of what they're really doing. Somebody who's actually worked with them before, which a good realtor probably has had some experience with that. And also what you might be able to do on the open market. When you put property on the MLS versus just going to one person to buy it, it obviously means that we're going to get more eyes on it, probably get more money in most cases on a multiple listing service, because it goes to all the hundreds and really thousands of portals now around the world to market your property versus just one buyer. So just something to keep in mind. I don't want to spend a lot of time on that, but that's kind of what's going on there. It's kind of an old thing that they had back, going on, that they were saying back in 2019. So in any event, just wanted to answer that and some other questions people had. about some of this other stuff here that we covered. If you guys have any questions at all, please never, you've been great at reaching out to us here. We love to answer any questions. You can always call or text us at 480-788-8569, or you can, make sure you like, share, follow us, comment on our social media, YouTube, Facebook, and we're over on Instagram. And make sure you share this with your friends. And you can always check us out at MancolaHomes.com, MancolaGroup.com. You can get some great information there. You can also search for homes there. We can send you more detailed portals, or home evaluations of what's going on in your area. And you can also email us at home@MancolaGroup.com, home@MancolaGroup.com. Thanks, guys, and we'll see you next time. Appreciate it.